Welcome everyone. Today we have a special guest. His name is Jonathan Taporco. And Jonathan, how you doing?
Doing great. Trying to stay warm.
Yeah, man. It's not usually cold in Texas, and we're both in Texas. So why don't you give everyone a little background, what you do, and how much in assets you manage?
Sure. So I work with mainly institutions managing defined benefit and defined contributions plans. So in my role here in Austin at the firm I'm currently with, we manage around $1 billion in those types of assets. Prior to that, when I was in New York City, we had around $2 billion in pension and 401k assets.
Nice. So you see, most of your institutional investing is probably mostly conservative. Is that right?
It depends on the institution and the main goal that they're looking to achieve.
Yeah.
So
cool. And so today, all my listeners and whatnot, I think we can all agree that the markets are crazy in all different ways. Mm-hmm. And I'll just give you my general thought, right? And it's one of two things. We watched your guy at Fidelity talk about it, in that corporate earnings are down. And when you look at valuations, the one key metric is the PE ratio, right? Mm-hmm. And it's really driven by the amount of dollars someone is willing to pay for $1 of earnings. So it's a pretty simple math equation. So you either have, a low amount of earnings with the same amount of dollars being spent, or the opposite, equal amount of earnings and people are just paying more money. Yeah. And it seems like it's a mixture of both. What are you seeing in the markets?
Well, if you think back to before all this Corona craziness happened, and then once it did happen, right? The PE ratio for the S&P 500, when you look at Q2 towards the bulk of the Corona crisis, it was around 21, right? Then FactSet released their data, right? It was around 24.3, the highest since it's ever been in 1998. And then we had earnings decline around 15% for the first quarter. So yeah, for the longer period, we should have some inflated PEs, but that doesn't really concern me. I think in the longer term, especially as these vaccines and things like that come out, hopefully the market will continue to go up as we start a new bull cycle, but we'll see how long it takes for that to actually happen.
Yeah, it's interesting, right? And again, for those of you out there that don't know much about stocks or valuations, again, the PE ratio is not the only barometer by any means, but it's definitely one that can quickly tell us where the valuations are in the market. And I'll put up a chart here to show you that right now at a 37 PE for the S&P 500, we are at the third highest valuation, if you want to call it that, in time. 2000 was the next one, and then after that, the 2010 crash. Again, decrease in earnings, elevated PE. That's kind of what we're talking about here. So it's interesting too, because there's a lot of wealth out there that's been driven by real estate increases, and that with that is equity. People take their equity out and invest it. There's a lot of speculative traders now with the platforms like Robinhood. Schwab now has no trading fees. Option trading has never been easier to get access. And on top of that, you have stimulus pumping a lot of capital into the money flows of our economy. So a lot of tailwinds are driving the demand for stocks. But like what your firm and your clients, when they ask you, like, Jonathan, the PE's at a 37. It's outrageous. Usually at a 25, that signals overpriced, right? What do you tell them in return?
Right. So we typically don't place too much emphasis on those types of fundamental factors. We tend to take more of a top-down approach. So we look at individual asset classes and from there try to form the strategic allocation. So if whatever their goal is, let's say, we're targeting a 4% rate of return, we'll look top-down, look at the specific asset classes we need to get from there in the equity markets and the fixed income markets. And then from there, look at individual sectors. So we're not really bottom-up managers where we're focusing on security selection and individual, security metrics like PE ratios and PEG, price earning growth, things like that. So our conversations, that area, are really, all right, if our strategic allocation, given that we're trying to target a 4 to 5% rate of return, to meet our pension liability is 70-30, right? 70% fixed income to 30% in equity. Given the macroeconomic backdrop, how do we want to tweak that particular strategic allocation? So that's the starting point for us, is developing the strategic allocation, and we'll use a combination of traditional and behavioral finance techniques to create that allocation, and then using various inputs, of which the economy is one of them, to tweak it, right? Yeah. So we already go in with the premise that we have a strategic allocation established. How do we want to adjust it given what's going on in the market? So think back to, middle and beginning of last year, when the yield curve started inverting, right? That's been a huge foreshadower historically of any type of potential drawdowns in the markets. So we kind of started sounding the alarm, saying, hey, let's go light on equities, maybe overweight fixed income.
Yep.
Take a tactical approach from there. So we're not trying to advocate all in or all out behavior based on market noise, so to speak. Just adjusting the base strategic allocation on a minute basis to take advantage of what we think may happen given different intellectual and emotional convictions that all the different noise is signaling.
Yeah, I mean, absolutely right. I mean, there's also a lot more risk at those larger amount of capital amounts, right? And again, for everyone out there, these are our opinions, not our advice. So do your own 100%. Research. But so, Jonathan, because I have my own strategy, and I'll tell everyone that what I'm doing. I swapped out of the S&P 500. I don't know, probably back in late October. I just saw a lot of speculation, didn't like it. And I pivoted over to emerging markets where I saw some value there. I pivoted over to big pharma, companies that had higher dividend yields, 4 or 5%. So AbbVie and Pfizer, which happened to be good before the COVID announcement. And there's also, I'm into a value fund ETF. So pretty risk adverse positions. And then I do have some gold and whatnot. So what are you doing in your personal portfolio, if you don't mind sharing?
Yeah, sure. So I'm a huge believer in cross asset class correlations. And one of the things that's concerned me, in recent years is that correlation amongst asset classes has increased. So if a lot of different asset classes are correlated with one another, it's hard to find an asset class that provides diversifying types of effects. So, one of the things that you mentioned was the S&P 500. I really think that they should rename that index to the S&P FANG 100. If you talk to any of my clients and ask them, I always refer to it as the FANG 500 index, because the majority of the returns in that particular index are driven by, the FANGs, and maybe now Tesla once it's included in the index. But for me personally, I'm underweight equities. In the fixed income markets, corporates, those scare me, as well as high yield with rates being so low. So, and with cash, with the rates being so low because of the Fed, one of the good things that you can use as a proxy for cash is tips. So overweight tips. And then I know you mentioned gold. I'm a huge fan. Go ahead.
Yeah. So for all you out there, when he refers to corporate, he's referring to the bonds. I think everyone's probably out of the bond market. I got out back in June, July, and then tips are basically what do they call them? Treasury
inflation protected securities.
What is it again?
Treasury inflation protected securities. So,
right. So it's basically a instrument that pegs against inflation. Is it inflation plus some sort of rate?
Yeah, the principal goes up and down its index to CPI rather than having a stated coupon, right? So let's say, you buy a tip, it's at $1,000. If inflation goes up, then you're getting a set coupon on not $1,000, but $1,020. Right. So because the principal value of the bond went up, then effectively the interest that you're getting on the instrument has increased.
Yeah, because it's on a higher base, more or less.
Correct. Yeah, and tips have done incredibly well on the year, which close to double-digit returns on tips in a 3-quarter period. That's kind of unheard of in government bonds and tips.
So net, our money flow per year. I don't know if net of all the stimulus, it's larger than it was, or if it's smaller. And I ask that because if you have $20 trillion of money flow in the United States, and then the stimulus comes out with additional $5 trillion, even if we lose $2 trillion from the COVID, 18 plus 5 is 23, right? So naturally, you just have more capital flowing around. That to me signals inflation. But if there's a $5 trillion stimulus package and we lost 6 to 8 trillion from COVID, that's a deflationary situation. Do you know offhand what our capital flows are?
I don't know the exact capital flow, but I do recall reading a statistic on Bloomberg that of all the money ever created in the history of man, close to 30 to 40% of it was created in the past year through all the different stimulus packages that President Trump released, and for unemployed individuals, which they duly needed, to stay afloat during the pandemic. But if you think about it, that's a mountain of money floating around, and that's one of the reasons I think the markets have somewhat recovered a bit. You have all this liquidity. Where is it going to go with rates near zero? It's going to go once the appetite for risk returns into risk assets and across the board. So equities,
real estate,
bonds, things like that, real estate, hard assets. I know you mentioned gold, which I'm a fan of, hard assets, things like that.
Yeah, it's interesting. There's a lot of noise happening, and I also again we're getting pretty deep here in technicals, but it is kind of needed. So one thing that scares me too about the dollar. I read an article in the journal last week, and this is inevitable. At some point, the yuan is going to be a reserve currency. I think today is it like 55% of all transactions in the world use the dollar, right? So essentially, people see the dollar as the most, the strongest currency, the most reliable currency, and I think that confidence is diluting a bit, and the yuan is starting to perk its head up as the next reserve currency. And if that happens and people do begin to shift over to the yuan or even the yen, I see a major devaluation of the dollar, which is pretty frightening.
Yeah, and I think it's important for a lot of investors to understand that a lot of the wealth and prosperity that we have as a country is tied to the dollar being the global reserve asset around the world, right? Without that, and without having the dollar as a reserve currency for the world, it could reduce our standard of living substantially.
Yeah, no, 100% agreed. And this goes back to support what Ray Dalio said too. Like the first thing you said was about correlation, right? If you, let's say you are investing in stocks and bonds and gold and real estate, but if they all have the same correlation or high correlation, right? Then they're all in the same trajectory and they're all exposed essentially to the same risk. So that's not really, yes, they're different asset classes, but diversity of risk doesn't really happen. They have to be essentially operating in their own bubble to hedge against risk. So that's one thing that Dalio has a really good video on, as he talks about the value of risk and the value of being diversified. But
so speaking of cross asset class correlations, right? Assets around the world are increasingly positive. They're increasingly being positive correlated, right? There's an increasing positive correlation amongst all asset classes, right? So that makes it harder for investors with large portfolios to reduce downside risk, right, and minimize drawdowns. Now, one of the few areas, and this is pretty controversial. One of the few, it's actually probably right now the only asset that I can think of that has no correlation to anything. And Fidelity actually recently published a paper on this, is Bitcoin, right? So if you look at all asset classes, typically there's some slight positive correlation to a slight negative correlation, right? So if you look at the S&P versus fixed income, right, there's a low to negative correlation there, which obviously makes sense historically. If the market goes down, bonds go up as investors flee risk assets and go into safety. But across all assets, Bitcoin has no correlation amongst any asset classes, right? I think Fidelity, they calculated the number, it's like 0.09, which is basically nothing, right? And that's across domestic equities, emerging markets, fixed income, right? Government bonds, every asset class. So If you take a standard 60-40 portfolio from 2000,
everyone, that's 60% stocks, 40% bonds.
yeah. If you take a 60-40 portfolio, which is pretty much the gold standard in a static allocation that you don't change over time for different inputs like age or risk tolerance and things like that. But a 60-40 portfolio from 2015 to now would have done around 7%, right? And then your standard deviation, which is your risk measurement for volatility, it's going to be around 9 or 10%, depending on the measurement period, right? If you added 1% in Bitcoin, you're basically going to get a 1% increase in return. So you're going to go from a 7% return to an 8% return without much increase in volatility. And in fact, it somewhat reduces volatility because, again, there's no correlation with Bitcoin amongst other assets, right? If you add a 3% increase, so basically, a 3% allocation towards Bitcoin, your return is going to go from 7% to 10%. And if you look at the Sharpe ratios amongst those portfolios with every 1% incremental increase in an allocation to Bitcoin, the Sharpe ratio goes up. And Sharpe ratio is the gold standard, one of the big risk metrics that we look at, just to generalize how risky is the portfolio and how much return are you getting per unit of risk, right? Which is your volatility measurement.
Yeah, this is fascinating, right? Because as the big hedge funds and as the big, private equity funds begin to look at places to hedge risk, and as the correlation of all assets kind of merges into one, right, Bitcoin naturally would be the safe haven, which sounds crazy because it's been a hell of a ride the last 10 years.
Yeah, and is it a medium of exchange? Is it a store of value? Is it a transaction network?
Yeah,
none of the above, all the above. That's yet to be seen. But purely from a mathematical standpoint, without getting into, the technical rabbit hole of how the transaction network works, how Bitcoin and blockchain works, but strictly from a mathematical standpoint of how the asset class has behaved relative to other asset classes, I think that the potential diversification benefits and the argument for adding it as a small percentage of your overall portfolio is there. Right. Yeah. You can't really argue with that. Now, whether or not, you have the emotional conviction that it's going to remain as an asset class and it's not just going to go to zero or get regulated out of existence, that's obviously a decision as an individual investor you'd have to make. But, having a small allocation towards it, I think makes sense.
Yeah. Wow. That's fascinating. I was very hesitant on Bitcoin until the last 12 months, because all these currencies, this has been a long sort of path of created currencies that collapse over time. And this one has just seemed to hold its value. So pretty fascinating. That's all good. So I did want to, so my earlier point that I was thinking about was the idea for those, and I have a lot of clients that have a lot of cash in the bank for a number of reasons. And I can't think of potentially a worse asset right now. Bonds are pretty bad too, but having cash just sitting in the bank is, do you agree that that's probably the worst asset to have right now?
Yeah. I mean, you're basically there's no risk. It's just long-term purchasing power risk is associated with cash. But where do you go in a world today where all the assets are correlated amongst each other? We're near all-time highs in the markets now, right? With the S&P around that 3,700 level, close to it. So, usually when we speak with our clients about, thinking back to the strategic allocation, how do you inform and develop the strategic allocation, right? You can do it using the traditional finance approach, which is purely quantitative and mathematical, or you could use a behavioral approach, right? Which takes into account individuals' intellectual and emotional biases and things like that. But I think if you look at the longer term, being underweight equity and just minimizing all in or all out behavior, right? If your standard allocation calls for 70-30, and given where the markets are all at near all-time highs, don't go all out of the market, right? You want some exposure, and depending on what your timeline is, right, you can modify it a bit, right? That way you're not going to miss up miss any potential upside. And if there's a huge drawdown in the market, right, you're not going to experience full drawdown either. But that's the big thing, is minimizing that all in, all out behavior and just modifying that strategic allocation. And again, reducing equity exposure, reducing corporates and high yield, maybe adding some Bitcoin or hard assets, looking at real estate, things like that, right? That's the name of the game right there.
Yeah, great. And that's, Ray Dalio, I mean, for the last 3-4 months has been talking about diversifying across asset classes, currencies, I mean, all sorts of things, because of the correlation that we're seeing with most assets. Yeah, it's definitely fascinating times. Yeah, so I don't know. I don't have the crystal ball. I'm still in the market. I still think about things, and one of my unique plays that I have is I'm a firm believer in big pharma. I read an article actually a book by Stephen Roach called Unbalanced. And in there, he talks about the year 2050, China is going to have the same per capita or income per capita as the United States, right? And you think about that, it's pretty powerful, right? Right now, pharma has had a hard time penetrating into China. And the theory is, as they become wealthier, they're going to desire our Western medicine. Even though the current president's very, very bullish in pushing the traditional medicine, I think pharma has a huge international opportunity over in Asia, and they're just stable, solid stocks. So that's where I put my money. They're undervalued relative to the S&P.
Yeah.
Trading at PEs of like 23. So I'm there with almost half my portfolio just to keep it as a safe haven. Might be a bad idea, but I'm taking the risk, getting 4-5% dividend.
Yeah.
And just hoping for the best.
Yeah. Well, I mean, if you look at the beginning of the year, healthcare, as with everything else, was hammered pretty much.
Yeah.
I think as of the end of Q1, it was down around 13%, as a sector. And as of now, if you would have bought in at the lows, you're up 5% year to date. So
yeah,
that was a good play on your side.
Awesome, man. So this has been great, and it's hard to keep it so high level when a lot of what we talk about and discuss or even, pontificate is based around quantitative reasoning, right? So it's going to sound like gibberish to many of you, but hopefully the ones that listened.
And that's the beauty of it, right? So you don't need to know everything to be a great investor. I know it's a little bit of intellectual conviction, a little bit of emotional conviction, and a whole lot of luck, right? So here's an example. Recently they announced that Tesla was going to be included into the S&P 500 index. So at that time, Tesla was trading around $450, right? 420, something like that. And usually when something is included in an index, shortly afterwards, it starts to run up. Because if you think of all of the index managers, Vanguard, BlackRock, Fidelity, they have, billions and trillions of dollars in these S&P 500 index funds. Once Tesla is included into the index, they have to buy it. So oftentimes, individual investors that aren't constrained by not being able to purchase it until it's actually included in the index, they'll oftentimes front run them, pushing the price higher. Now, intellectually, that made sense to me. And even then, I didn't have the emotional conviction to commit to that. So, we were looking at purchasing some Tesla calls, just short-term calls, because the stock is going to be included in the index sometime in the middle of December.
I think it's the 15th.
Yeah. But if you were to get a Tesla 465 call for December 31st expiry, a few weeks ago it was trading $20 an option, right? So if you bought one of those options, you would have been up 10 to 15,000 depending on the day that you looked at it.
Crazy.
But the emotional conviction wasn't there, right? So and that's obviously, if you would have bought that option, again, it's a little bit of luck, a little bit of emotional conviction, and a little bit of intellectual conviction.
Yeah.
Or more so, a lot of. Right. So that's the thing when it comes to the capital markets.
100%. And that same thing, applies now, maybe not as founded in reason as this
Yeah.
with Google when it first came out, with Bitcoin when it first came out. So it is that conviction. I had one recently, Datadog. I had some call options. I had a big wager on that, and essentially it was gambling. But I knew that they were going to beat earnings. They did beat earnings, but not enough to the liking of the street, and I got hammered. Right. So it's like even when luck is on your side, sometimes the emotional reaction of the market it's just not there. So
right. And you and I have had conversations about this before, but getting rich slowly is boring.
Yeah.
Right. A methodical strategic allocation and investing into it regularly, it's boring. That's why a lot of people
but it works.
Stick with the plan, but it works. And there's a number of things that you can do. And we've had discussions about the barbell approach to kind of turbocharge your way to accumulating wealth. Having a core allocation, a boring 60-40 portfolio, and then outside of that, with small amounts of money, small amounts of capital. Right, you don't want to go too crazy trying to hit those home runs like that. Right, sometimes you're going to lose, sometimes you're going to win, but if you win 3 out of 10 trades, you're ahead. Right.
In fact, I just had this conversation on Thursday with a client of mine that's just soon will be going to IPO and making a good amount of money, and he's questioning how he should allocate his millions. It's like, well, that's a lot of money. First of all, so the first step is to have your stable portfolio, like you're saying, and then much smaller amount. Consider having it allocated towards speculative trading, speculative investments, or the home run deals. Right, the ones that if it pans out, you'll be doing just well, but there's not enough risk in that small piece of the portfolio to really sway the overall performance of your portfolio. So I think that's spot on. I see a lot of traders or a lot of people, my clients, that are putting a majority of their assets in these trades that are speculative, the Teslas of the world, in hopes of these home runs. And it's like that's where it gets dangerous. Is when you're putting money that you can't afford to lose in the speculative, positions. Cool, man. This is great. So, I've been trying to get you on this podcast for a while, because I think your knowledge is far deeper than most people that are out there on YouTube talking about who knows what.
I like to pretend that it is.
Yeah. So definitely appreciate that. Jonathan, thanks, man.
Yeah, no problem.